The global AI commerce market is projected to surpass $6 trillion by 2030. Not the broad digital economy, not software as a general category. The specific intersection of artificial intelligence, data infrastructure, and next-generation manufacturing being embedded into the operational backbone of how modern enterprises transact and compete. Sitting inside that transformation are three small publicly traded companies on the NASDAQ, each occupying a distinct lane within this infrastructure build-out. Institutional positioning remains thin across all three, and yet the operating metrics are moving in directions that deserve serious analytical attention. Let's go through each one. The first company is Rezolve AI PLC, ticker RZLV, currently trading near $2.13. Rezolve has built what it describes as the world's first enterprise AI platform, designed for agentic commerce, that doesn't merely assist commercial transactions, but autonomously executes them. Their brain suite processes search, transactions, fulfillment, and personalization simultaneously for global enterprise clients. By December 2025, the confirmed client roster had grown to more than 650 enterprise customers, including Adidas, Gucci, Burberry, H&M, Converse. It's not a startup list. That is broad-based enterprise validation across retail, fashion, and financial services. If you find this kind of analysis valuable, please take a moment to like this video and subscribe. It helps surface these conversations to investors who need them before institutional momentum fully builds. Revenue for 2024 was pre-commercial as the company built its operational foundation. The inflection came in 2025. First half revenue reached $6.3 million, representing more than 426% growth year over year. Gross margin came in at 95.8%, significantly ahead of analyst expectations, reflecting the economics of a SaaS model architecture. By December 2025, preliminary revenue exceeded $17 million for the single month. The company exited 2025 with annual recurring revenue exceeding $200 million, and management has initiated 2026 guidance at a $500 million ARR exit rate. 2Q3 2025 financings totaling $250 million left approximately $230 million in cash on the balance sheet. This has gone largely unnoticed by the broader market. The risks are real. GAAP net loss persists due to non-cash charges and one-time acquisition costs. Dilution risk exists through shelf filings. Revenue recognition depends on enterprise contract execution and acquisitions integrating cleanly. Converting ARR momentum into sustained GAAP profitability is the central unanswered question. Three scenarios emerge. Pessimistic, around $1 to $1.50, assumes enterprise delays, continued losses, and dilutive financing. Base case, $3.50 to $5, assumes ARR approaches $400 million, and margins improve through 2026. Optimistic, $6 to $9, assumes the $500 million ARR target is achieved, and the stock re-rates toward a software valuation multiple. The gap between current operational momentum and current valuation is where the thesis lives. The second company is Datavault AI Incorporated, ticker DVLT, currently trading near 68 cents. Datavault operates at the convergence of two distinct trends: the monetization of real-world assets through blockchain tokenization, and the commercialization of foundational patents covering spatial audio and wireless data transmission. The data science division focuses on Web 3.0 infrastructure, digital credentialing, identity verification, and real-world asset tokenization across healthcare, energy, biotech, and financial services. The acoustic science division holds issued patents in spatial audio, wireless HD transmission, and multi-channel interference cancellation through its nyse, ADIO, and Sumerian technologies, standards that any commercial entity in those spaces must license. Like this video and subscribe if you want more analysis on companies building critical infrastructure before the broader market fully prices it in. FY 2024 revenue was approximately $2.7 million. Preliminary unaudited FY 2025 revenue is estimated at $38 million to $40 million, representing roughly 1,300% growth year over year, driven by technology licensing fees and tokenization services. In Q4 2025 alone, the company signed $49 million in tokenization and licensing agreements. A material capital event occurred in late 2025. Silex Holding Company agreed to a $150 million strategic investment, structured in 2 tranches. The initial $8 million tranche closed in September 2025. The second tranche of approximately $142 million remains subject to shareholder approval. Committed, but not yet received. For 2026, official guidance targets $40 million to $50 million in recognized revenue. The risks here are substantial. Going concern language remains in Datavault's filings. The second tranche of the Silex investment, representing the majority of that $150 million, has not yet closed. Revenue from tokenization and licensing contracts can be lumpy and contract dependent. Pessimistic scenario, $0.25 to $0.45, reflects execution failure. Shareholder rejection of the Silex tranche and dilutive financing. Base case, $1 to $1.75, assumes the Silex investment closes. 2026 revenue reaches $40 million to $50 million, and IP licensing proves repeatable. Optimistic, $2.50 to $4, assumes Silex capital is fully deployed, node infrastructure scales, and additional licensing expands the revenue base. Position sizing discipline is essential. The upside is asymmetric, so is the downside. The third company is Nano Limited, traded as an American depository receipt. Ticker NNDM, currently trading near $2. Nano is structurally distinct from the other two. It is a digital manufacturing company serving defense, aerospace, automotive, electronics, and medical device industries through advanced additive manufacturing of electronics and precision components. Their technology enables production of complex customized parts without conventional tooling, compressing timelines dramatically while protecting intellectual property within the manufacturing process itself. Subscribe and turn on notifications. These are exactly the kinds of analytically underserved opportunities this channel is built to surface before institutional recognition arrives. The company underwent significant transformation in 2025. Nano acquired Desktop Metal in April 2025 for $179 million and Markforged in April 2025 for $116 million. Desktop Metal subsequently filed for Chapter 11 bankruptcy on July 28, 2025, resulting in a full asset impairment of $139.4 million and deconsolidation into discontinued operations. Markforged remains fully consolidated and contributed $17.5 million of the $26.9 million in Q3 2025 revenue, which represented 81% year-over-year growth. 9-month 2025 revenue was $67.1 million, up 55% year-over-year. Cash and investable securities stood at $515.5 million as of September 30th, 2025, down from $840 million at the start of the year. The current market capitalization is approximately $400 million, meaning the stock trades at a discount to its liquid assets, even after accounting for operating losses. A formal strategic alternatives review is underway with Guggenheim Securities and Houlihan Lokey, which could include a sale, merger, or other value-maximizing transaction. The thesis centers on whether management can convert this capital-rich platform into consistent revenue growth at improved margins. Risks include ongoing net losses, Markforged integration complexity, standalone legacy revenue that declined 37% year-over-year in Q3 2025, and the financial weight of the Desktop Metal bankruptcy impairment. Operating expenses are targeted to decline 10 to 15% in 2026 as synergies materialize. Pessimistic scenario, $1 to $1.50, assumes strategic review produces no premium outcome, and cash burn accelerates. Base case, $2.50 to $3.75, assumes the strategic review concludes favorably, Markforged integration improves margins, and the cash discount to market cap begins to close. Optimistic, $5 to $7, assumes a strategic transaction realizes meaningful value above current market pricing. These three companies share something that long-term investors should recognize. Each is building inside infrastructure layers that historically have rewarded patient capital disproportionately once institutional recognition arrives. The window between genuine operational traction and broad institutional discovery is where asymmetric opportunities have consistently appeared. That window appears open today across all three. None of this is guaranteed. All three carry execution risk, capital risk, and competitive risk. Revenue guidance represents management projections, not audited results. Size positions conservatively and protect your core portfolio before extending into higher risk opportunities like these. Do you believe AI commerce infrastructure, real-world asset tokenization, and on-demand precision manufacturing will be materially larger industries 5 years from now? If yes, studying ground floor players while they remain underfollowed is disciplined research. Leave your perspective in the comments. If this analysis was useful, like and subscribe. This is educational analysis, not financial advice. Stay disciplined, stay informed, and remember that lasting wealth is built not by chasing momentum, but by identifying durable trends early and holding through the volatility that always precedes recognition.